Credit control is an important weapon or a major weapon used by the Reserve Bank of India in order to control the demand and supply of money in the economy. It is done by RBI through controlling the credit granted by commercial banks to the public. And this method will help the RBI to bring about economic development with stability. The credit control done by commercial bank can be broadly classified into two, that is the quantitative method, which is the general credit control measures, and the qualitative method, which is selective credit control measures. Now, what are the objectives of credit control? That is, credit control is done in order to bring about price stability. That is, if there is too much fluctuation in the prices of goods in the economy, it can be due to excessive supply or undersupply of money in the economy. So this can be controlled through controlling the credit. Also, it helps to achieve stability in foreign exchange. What is stability in foreign exchange? It means that suppose say today $1 is equal to 62 rupees. Say the very next day it moves to 70, and the next day it moves to 80. So it means that there is too much fluctuation in foreign exchange rates, and this can be due to the inefficient flow of money in the economy, which can be controlled through credit control, and thereby it helps in maintaining stability in foreign exchange. It also helps in elimination of business cycles by controlling credit. That is, suppose if there is boom, it means that there is too much fund or excessive supply of funds in the economy already. So the objective of RBI is to take away all these funds, and therefore such measures will be taken so that the funds from the economy will move to the government, move to RBI, and vice versa. In case of depression, it means that there is not enough funds in the economy. So to revive the economy, what the RBI does is it will release all these funds through their credit control measures in order to protect the economy. And all these steps above will lead to economic growth. If there is proper flow of funds in the economy, and if there is proper credit control, it will help in the economic growth in total. Now, moving to the various methods used for credit control, as I already said, we can classify the credit control measures into two, that is the quantitative measures or the general measures, and the qualitative measures, that are the specific methods. Or qualitative methods means those methods which are limited to a specific area, okay, controlling a specific area. Now, let us go see what the quantitative measures are. The first one is bank rate. Bank rate means the rate at which the Reserve Bank of India lends money to commercial banks. So what happens here? If RBI wants to control the credit that is moving into the economy, okay, suppose they want commercial banks not to lend too much money to the economy, then what they can do is they can increase the bank rate. So when RBI increases the bank rate, then the rate of interest that the commercial banks should pay to RBI will be increased, and therefore the loans taken by commercial banks from RBI becomes expensive, and so in return the commercial banks will not be able to provide or grant too much loans to the public. And vice versa, if the RBI wants funds to flow into the economy, then what they can do is they can reduce the bank rate, so the funds are available at cheap rates from RBI to commercial banks, so that the commercial banks can also grant more and more loans to the public. Then the next one is open market operations, which means that the RBI will purchase and sell the securities of the government, or the bills, the bonds, etc. issued by the government. How do they do that? Okay, say again, if RBI wants more and more of funds to flow into the economy, what they do is the RBI will purchase the securities which is there with the public. The RBI will purchase all these securities. Okay, and can be there with public, can be there with the commercial banks. So RBI will purchase these things. So the securities will come to RBI, whereas in return the funds will go to the public through commercial banks. Similarly, if RBI wants to take back all these funds from the economy, then what they can do is reverse it, sell all these securities into the market. So when people are having too much money and RBI wants to control that, then what they do is they'll sell all these securities. So securities will move into the hands of the public and all the money will be returned to Reserve Bank. This is what we mean by open market operations. Then the next one is legal reserve requirements. Now legal reserve requirements means RBI insists commercial banks to maintain certain reserves while doing their transactions. So here CRR means it is the reserve that is to be kept by the commercial banks when they have deposits. Okay, so when a commercial bank has a particular deposit, they'll have to keep a percentage of these deposit as reserve with RBI, and then they can use the balance. Suppose if a person gets 1000 rupees deposit, and suppose if your CRR rate is 20%, then the commercial bank will have to keep a reserve of 200 with RBI, and they can use the balance 800. So this 800 obviously they will be using it for credit creation. Okay, so if the RBI wants funds to be pumped into the economy, then they can lower this rate. If they don't want funds to flow into the economy, if they want to keep it away or control the credit, then they can increase this rate so that only less amount will flow into the economy in the form of credit. This is about CRR. Then SLR. SLR again means it is a certain percentage of their liabilities, that is the commercial bank's liability. For this, they'll have to keep a reserve again with the RBI. It can be in the form of cash in hand, the gold, the central or state government securities, balances in current account with RBI, or state bank and its subsidiaries. So they'll have to keep a certain percentage of the bank's liability as reserve, which we call SLR, statutory liquidity ratio, and CRR means cash reserve ratio. Okay, so they are required to keep a certain percentage of their bank liability and term loans as reserve. And what happens again? They have to keep a certain percentage, and therefore they cannot lend too much to the people because they'll have to meet this reserve requirements. So again, as the case above, if the RBI wants funds to be pumped into the economy, then they can lower the rates. If RBI don't want funds to be pumped into the economy, then they can increase the rate.